Hello students, how are you? In today's lesson, we are going to learn about retirement of partners, right? Earlier we have seen admission of partners. We are admitting a new partner into the partnership, right? Here we are going to see the retirement. At the admission also, we have seen when we are admitting the new partner, we used to revalue the assets, and we used to calculate the goodwills, so on and so forth. The same thing here also we used to do for the at the time of retirement, but here the scenario may be different, right? Because when we do the questions you can understand, right? Goodwill, for example, if you say a B and C are the partners, right? These people are what you call running out. Currently they are doing the partnership, right? In the sharing the profit and loss ratios into 5 is to 4 is to 1, or 5 is to 2 is to 1. 5 is to 2 is to 1. In this profit sharing ratio they are carrying out the partnership, but the C decided to leave, right? The C decided to retire from the partnership. At the time of retirement, right, the goodwill and the assets also will be revalued and shared among the profits will be shared among the all three partners. Goodwill and revaluation of profit and loss will be shared among the all three partners, but the profit sharing ratio, there may be a what you call difference in the profit sharing ratio, right? Here they will adopt a elimination method. There are two methods, elimination method and long calculation method is there, right? Most of the people used to do the elimination method in the sense, see, earlier we calculate the profit sharing ratio is 5 is to 3, 2 is to 1. Then when the x is removed, then it's retired, then remaining is 5 is to 2 is the profit sharing ratio. In this profit sharing ratio they will continue their partnership, right, without any amendment. Lengthy calculation method and lengthy profit sharing ratio method also there. This is the easiest one to calculate. So adopt this method and calculate the profits and losses thereafter, right? Elimination method we used to adopt, right? So let's move on to the small question. From that you can understand how to calculate the goodwill and things so on. The This is X and Y are partners sharing profits and losses in the ratio of 3 is to 2, right? 3 is to 2. 3 is to 2 is to 2. 2 is to 1, right? 3 is to 2 is to 1, right? And respectively, goodwill of the firm is valued at 60,000, right? 60,000 goodwill. Z retires from the business. X and Y decided to continue the business, sharing profits and losses in the ratio of 3 is to 2, right? Elimination method, 3 is to 2. They are going to calculate carry on the business with the 3 is to 2 profit sharing ratio, elimination method they have adopted, right? So give the journal entries and prepare the goodwill account when goodwill is raised in the books for full value, right? So we have to open a partnership account and goodwill account, right? Partnership account, say partnership account, right? This is a partnership account, partnership capital account, right? Partners capital account, capital account, right? X Y Z, X Y Z, right? Description, right? Here we will say goodwill account, goodwill account. A, question number A, here we will say A, right? A says goodwill is raised in the books for full value. They say 60,000 is the goodwill. Goodwill is the 60,000. Amount of the goodwill is 60,000, right? So you have to raise the goodwill account. Goodwill account, we have to, or we can, right? We can journal entries, debit, sorry, debit and credit, right? Journal entries, journal entries, description, right? Here they say 60,000, he is bringing the 60,000 goodwill is created. Then what is the goodwill? Double entry for goodwill account A, right? Goodwill account debit 60,000, credited to capital account of X, Y, and Z according to the previous profit sharing ratio, that is 6. That means 30,000, 20,000, and 10,000, right? So this is the double entry for creating a goodwill, right, at the time of retirement. So here you will say their balance brought forward will be there. Balance brought forward will be there, right? Here goodwill account, right? Goodwill account debit 60,000. Goodwill account debit 60,000, saying capital, right? That is X, Y, and Z. 30,000, 20,000, and 10,000. That's right. These three is 60,000, right? 60,000. Here in capital account we say goodwill bill account, right? 30,000, 20,000, and 10,000. Finished. This is the entry for the A, number A. Right, this is the number A. right? This is goodwill is raised in the books of in full. Goodwill for 60,000, we have created a goodwill 60,000. So here carrying down value would be 60,000, right? Carrying down value would be 60,000. Brought forward value would be 60,000 because the books will show the goodwill account for the A. Question number B. Question number B says goodwill is raised and written off in the books. Raised and written off. So here we will say goodwill. Goodwill account. Right? Goodwill account. You have to open a goodwill account. Right? Here you have to say what is the double entry? Create the goodwill account. Creating a goodwill account. That right? Goodwill account debit. Account debit 60,000. Capital. Account X, Y and Z 30,000, 20,000 and 10,000, right? Just creating a goodwill. This is a entry for the creating a goodwill. Goodwill account debit, that is capital account X, Y, Z, that is 30,000, 20,000 and 10,000, right? We will say B, creating goodwill 30,000, 20,000, 10,000, right? Created the goodwill. Now we are going to written off it. Written off in the sense capital account debit X and Y, right? Goodwill account credit. Goodwill account 60,000 credited. 60,000 divided by 5, 12,500 one portion. Then 25 for Y 25, right? 25,000, 37,500. 12,500, 12,500 is no, sorry, 12,000, no? 12,000 means 24,000, 24,000 and 36,000, right? 36,000. It is written off. Goodwill being written off. This is goodwill being goodwill written off. Right? This is being creating goodwill. Right? That is it. So here we are going to write off the goodwill. Capital account, goodwill account credit 60,000. Right? That is capital account X and Y 36,000 and 24,000. It is 60,000. here 60, 60, no balance, no balance, no balance. And here we have to say capital goodwill account, right? 36,000 and 24,000, right? This is written off. This is created. Goodwill created. This is written off, right? This is the entries for this question. So now you would have understood how to create the goodwill at the time of admitting the partner, at the time of retiring the partner, and you know at the time of retiring partner how to create the goodwill and how to write off that goodwill. This is the double entry for creation, and this is the double entry for writing off the goodwill, right? So I don't need to separately give you the double entry accounting treatment. So here itself you would have got it, right? The question will appear in the video, right? You can see. Okay, I hope you would have understood, and I will see you in next session. Thank you.